Thank you, Anil. Great to be with you again, and I'm pleased to speak with you about um, the global property fund's performance during the most recent quarter. You can see that real estate has had a challenging quarter on a global basis, really due to a sharp increase in interest rates, we think, during the quarter, particularly in the month of August. We saw that performance across most of the sectors, property sectors, really was challenged in the past quarter. Office was the sole one that had a positive performance after having been really a bounce after having been oversold. And then regionally, Asia Pacific was a bit stronger, really because of Japan. And then Europe and the UK also were positive. We saw struggling performance, negative performance in other markets around the world, particularly the US. Uh, as I said, bond sell-off really drove a lot of the sentiment around performance. We saw REITs lag broader equities. And on the direct real estate side, we haven't seen a lot of transactional evidence because the bid-ask spread hasn't closed yet. But sellers are still hoping for prices that were values that were set kind of before we started to see rates rise, and subsequently the levered buyer has stepped away, and so as a result, we see fewer bidders for properties right now. Finance is more difficult to obtain. As a result, cap rates have widened. However, I would say that the operating conditions for commercial real estate remain really quite stable, quite robust, which stands in quite a bit of difference to where we see the transactions market. When we look at the companies in our portfolio, again, operating conditions are strong. Capital structures are really quite strong now for most of the REITs. Outside of continental Europe and a few in Asia Pacific, REITs have really taken advantage of the past 10 years plus since the GFC to deleverage their balance sheets. We are monitoring some areas where operating conditions are more challenging, such as the U.S. office market, where we've started to see some dividend cuts as a result of declining incomes. And that would also go for European stocks, where they carry higher leverage. This performance during the quarter, again, it was a very challenging quarter for the real estate market. And when we look at what contributed to performance during the quarter, strong performance out of diversified, really driven by performance in Japan, as I said, with Mitsui Fudosan as one of the larger positions in the portfolio, and then healthcare. And healthcare, particularly in the U.S., was driven by seniors housing, where there's just a very strong demand story in the absence of really any new competitive supply. And then, as you would expect, in a market an environment where equities were challenged and you actually got paid to hold some cash, cash was a positive contributor to performance. You can see at the other end, data centers really struggled. This is a situation where values got a little bit ahead of the thematic. We are very constructive about data centers over the short, medium, and long term. The stocks had just had a really supercharged second quarter and gave a little bit back. And then retail and industrial both were challenged during the quarter. Really more on sentiment and multiples than on operating fundamentals, which remain quite strong. You can see regionally, the U.S. was the largest contributor to returns, positive returns. Again, we have the healthcare exposure is really based in the U.S., and so that was a real positive. And then Europe was a negative contributor to returns, and that's really due to some of the underperformance with levered positions there. We can see now that there's a real disconnect between where REITs are trading in the light green line in the middle and where equities are trading in the slightly darker green line above. And this is a gap that's persisted really since coming out of the pandemic, and it's just widened, and it's really widened to a notable level where we're finding that real estates look quite quite interesting value on a multiple basis compared to global equities. What I want to talk to you about was really some of the thematics that are driving portfolio construction, and we're in as we enter a period of more uncertainty in the economy and frankly politically, we're doubling down and really focus on areas that are really necessity real estate, really economically relevant real estate. So that would include community shopping centers, retail and community shopping centers in the U.S. These are grocery anchored shopping centers. They're located in the communities they serve, and because people go to the grocery store quite frequently, we find that visitation to these properties has remained quite robust. And in fact, we're starting to see tenants that otherwise would have been in regional malls move into the shopping center environment because they continue to have the draw, the customer draw. So as a result, occupancies for the shopping center companies in the U.S. Are really near all-time highs. And I'd point out that the properties owned by the shopping center companies in the U.S. are among the best in the country. There might be a retail oversupply issue, high retail square meters per capita in the U.S., but the properties that the REITs own are really well positioned. And so as a result, we're starting to see tenants actually compete for space that becomes available in some of these stronger centers, and the shopping center REITs are able to drive rents at or above the rate of inflation. We're also seeing retailers, the tenants themselves, start to kind of fit out their stores and provision them for last mile distribution. Again, last mile distribution is one of the most expensive, is probably the most expensive part of the distribution network for e-commerce. And we're starting to see a bit more provisioning for e-commerce fulfillment out of retail stores. Stores like Target are actually leasing slightly larger space in order to accommodate that. The other area I want to talk to you about was rental housing. We call it residential. In the U.S., it really is across a broad spectrum that would include traditional purpose-built multifamily buildings, apartments. It would include single-family residential, so single-family homes that are now rented out. And it would also include manufactured housing, which are mobile homes. We find that particularly in the U.S. and in other markets as well, housing is undersupplied. Coming out of the GFC, we never really saw the robust rebound in housing construction that was necessary to accommodate all of the new demand that was occurring due to population growth and immigration and whatnot. As a result, the operating conditions are quite strong. Occupancies are high. We've seen some supply response, but not enough to really curb rent growth. And so we're really quite constructive on residential rental housing. Then healthcare is really, it's a few different things, but what is exciting to us about healthcare today is seniors housing. Seniors are just beginning to age into the prime senior housing demand cohort. So think of the baby boomers who were born kind of 1943 to 1948. We're just starting to see them crest 80 years old, which is really when we expect to see really quite a pickup in seniors housing demand. We're also still recovering from the occupancy that was lost during the pandemic. We're midway through what is going to be probably a 4 to 4.5 year occupancy rebuild. And then finally, I'd point out that because construction finances become much more challenging for commercial real estate, with just a few exceptions, we've seen very little senior housing construction. And so the supply outlook for seniors housing is really quite benign today compared to what it's been historically. So as a result, we actually expect there to be several years of occupancy growth and above inflation rent growth. Then I want to talk to you a little bit about data centers. We expect to see further digitization of the economy, where we expect to see more and more data that is housed in purpose-built, professionally run data centers. Everyone talks about AI, and AI is a very strong demand-driving thematic that just hasn't mattered yet on data center demand. We expect that to manifest and matter over the next kind of 3 to 5 years. We're just not seeing that demand yet, which is why we think the data centers on the attribution side maybe got a little bit ahead of themselves. But we remain really quite firm in our commitment and our belief that data center demand is going to continue to grow quite robustly from here. And then I just want to mention logistics, which in logistics has really become the backbone of almost everything. We've seen e-commerce and the drive towards efficiency of distribution really power demand for modern logistics facilities. And it's really two different types of facilities. One are the large bulk distribution facilities that are located in areas that can then serve the last mile distribution facilities, which are located really within the communities and close to the communities they serve. And in those situations, last mile demand for properties really is really quite keen, because there's many other uses that could happen for those properties than just logistics, such as housing or retail. And so we find that there's real scarcity value for certain types of logistics properties. As a result, they have very strong and robust rent growth. When we look at commercial real estate overall, the operating fundamentals are really quite strong. Supply occupancy is if it's not at all-time highs, it's really quite strong. And then on the supply growth construction, we start to see a pickup, of course, but you can see at the far right side of the page, the graph on the right side and the far right side of that graph, there really has been a slowdown in the pace of new construction activity. As a result, because of the operating environment is quite constructive, we expect to see strong income growth going forward for REITs. Really quite constructive about the outlook there. The other thing I'd say is that there are constraints to supply. Not only is there finance cost challenges, but we've seen actually all the input costs, the hard costs, the labor costs, the materials have picked up quite a bit. And so looking forward, with just a few exceptions, such as apartments in the Sunbelt part of the U.S., we're just not expecting to see significant amounts of new construction activity. REITs today are extremely well capitalized relative to real estate overall and relative to where they've been. We see here a chart that illustrates just how low the net debt to EBITDA, the serviceability of the debt, has gone for U.S. REITs and for Australian REITs. Leverage is now below 30%. Maturities are laddered, which means that they're manageable, and that we have more fixed rate and hedge debt than we've had before. As a result, we find that leverage is far less of a concern today. It's not a concern because, of course, all debt is going to be repriced higher given the higher interest rates, but it's not nearly the ticking time bomb that leverage has been for real estate in the past. As a result, I'd tell you that we think that REITs are trading at quite visible discounts to direct real estate. So we find that there's value within real estate for REITs, which is an important valuation backstop for the sector. In terms of positioning, residential is the largest exposure, quite constructive of rental housing. Then retail, really driven by necessity retail, data centers, healthcare, and then industrial. Those are the largest components of the portfolio. You see office at 6%. It's a very small number. Office has really atrophied as a part of the index overall. We're concerned about the commercial office outlook for most markets, particularly in the U.S. Our office exposure is concentrated in Tokyo, where you're just not seeing a lot of work from home, given some of the size of the residential homes there and the culture, and also in London, where there continues to be quite tight conditions in the West End. In terms of regional construction, the U.S. Remains the largest part of the portfolio regionally, followed by Japan, where we have the office exposure with Mitsubishi Estate, and also more diversified exposure with Mitsui Fudosan, as well as Nippon Prologis for industrial. The UK, where we're actually seeing conditions, the economy hold up quite well in the UK. Outside of housing, which has slowed, a weaker sterling has supported tourism into the UK, which has supported activity in central London. We also have exposure to Unite Group, which is a student housing operator, really the leading student housing brand in the UK. This is the largest top 10 positions in the portfolio. About 48% of the overall portfolio is concentrated here. It's a large cap portfolio. It's very liquid. It's well diversified by property sector. You see residential, data centers, industrial, healthcare. A lot of the thematics that we've been talking about are represented here and in the portfolio construction. And I just wanted to mention a picture will tell 1,000 words. Just look at healthcare here. You can see the ramp up in the chart on the right, the over 80 population, and then you can also see the chart on the left chart, just the ramp down in senior housing inventory. Because we're a little bit short on time, I just wanted to go ahead and point out one other picture on Equinix, which is the largest owner of data centers in the world. You can see their footprint. What's really important to understand with data centers is just how many of their customers are in multiple regions. Over half of their customers are in at least 2 regions, and over a third of their customers are in 3 regions. So as a result, I'd say that REITs are trading at discounts to direct real estate values. Capital structures are quite strong. The operating outlook is we're constructive on the operating outlook. That would assume that if there were to be a recession, that it would be a more mild and shorter recession. If there's a deep recession, I think real estate is just one area among many that people would have to come back and revisit because demand could be at risk. But at this point, that's not our base case scenario. REITs continue to provide the income that everyone expected. Dividend yield now is about 3.5%. It's well covered, and we expect for most of these companies for the dividend to grow with earnings going forward. With that, I just wanted to thank you for your time today.